In the previous video, we reviewed Michael Marcus, the legend who was worth the equivalent of at least 10 average traders. Today, we will look at one of his apprentices, Bruce Kovner. This guy doesn't play around either. At the time of the writing of Jack Schwager's Market Wizards, Bruce Kovner had an average return on equity of 87% per year during the last 10 years. Which means that if you invested $2,000 with Kovner in early 1978, you would have ended up with over $1 million 10 years later. The road towards becoming a market wizard wasn't always laid out for Bruce Kovner. He started his adult life as a teacher, and later he had a run in politics. It wasn't for naught though, as he thought that his studies of and experience in economics and politics would lead him to become a better fundamental analyst. And right he was. Bruce Kovner thinks that risk management is the most important thing for novice traders to understand. His advice is that every beginner should undertrade. Whatever you think your position ought to be, cut it in half, he says. He himself tries to never risk more than 1% of his equity in a single trade, and he recommends risking no more than 2% maximum. Also, he's watching all his positions in the portfolio to make sure that the bets he's taking aren't too correlated. For instance, if you risk 2% of your capital, but you do that in 10 different oil stocks, you can't really say that you are risking 2% on each of the positions anymore. Why? Because these 10 stocks will basically move in tandem with the price of oil. So it's closer to the truth to say that you are risking, well, maybe 15 to 20% on such an allocation of capital. If you have 10 highly correlated positions, then you are really trading one position that is 10 times as large. Furthermore, Bruce Kovner treads lightly every time he's confused by whatever the market is doing. If his emotional equilibrium is disturbed, he closes down all his positions regarding the event that is confusing him. He summarizes this in his first rule of trading. Don't get caught in a situation where you can lose a great deal of money for reasons that you don't understand. For Bruce himself, such a situation was the market meltdown that was the Black Monday of 1987. Therefore, during the 19th and the 20th of October that year, which was the day of the crash and the day after it respectively, he closed all his positions temporarily. The next time will be the final episode of this miniseries. Then we'll be reviewing Michael Steinhardt, who had an interesting bankroll management in the early years of his trading career, as his father was subsidizing his activities with money made from stolen jewelry. Hope to see you then.